Modern banking isn't built on cash, it's built on trust. It's the simple belief that the money you deposit today will still be there tomorrow. The faith that our banks are stable, regulated, and secure. But in 2007, here in the United Kingdom, that belief was put to the ultimate test. What happened next wasn't just a single failure. It was a chain reaction that brought the entire British financial system closer to collapse than at any point in modern history. Our story starts with a bank called Northern Rock. On the surface, it didn't seem reckless. It looked modern, efficient, and was expanding at an incredible pace. But there was a critical difference in how it operated. Unlike traditional banks that use customer deposits to fund their loans, Northern Rock had a different strategy. It borrowed huge amounts of short-term money from global financial markets to issue long-term mortgages to its customers. This model worked beautifully, fueling its rapid growth, till it didn't. In the summer of 2007, the global credit markets, the very wellspring of Northern Rock's funding, began to freeze. The easy money that had flowed so freely suddenly vanished. Northern Rock found itself in a trap, unable to roll over its short-term debts. Desperate, it went to the Bank of England for emergency support. The moment that news hit the public, confidence didn't just waver, it shattered. What followed was a scene that hadn't been witnessed in Britain for over 140 years. People lining up outside bank branches, forming long queues, all desperate to withdraw their life savings. The images were stark, a throwback to a bygone era of financial panics. Within just a few days, billions of pounds were pulled from the bank. The government had no choice but to intervene. By early 2008, Northern Rock was nationalized, taken into public ownership. It wasn't because it was the biggest bank, it was because its failure exposed a terrifying truth. The entire system was fragile. While Northern Rock revealed a vulnerability, another bank, the Royal Bank of Scotland, or RBS, represented a far greater danger: systemic risk. By the mid-2000s, RBS wasn't just a major UK bank. It had transformed into one of the largest financial institutions on Earth. Its expansion was nothing short of aggressive, and its appetite for risk was enormous. The tipping point came in 2007. RBS led a consortium to buy a Dutch bank called ABN AMRO. It was one of the largest banking takeovers in history. But the timing could not have been worse. Just as the deal was completed, the global financial crisis exploded. Suddenly, RBS was massively exposed. It was drowning in collapsing asset values, toxic securities, and was facing losses of an unprecedented scale. By early 2009, any remaining investor confidence had evaporated. The bank's share price collapsed, becoming virtually worthless. The failure of a bank the size of RBS would have been catastrophic. It wouldn't have been a contained event. The entire payment system would have ground to a halt. Credit would have frozen solid. Businesses wouldn't be able to pay their staff. People wouldn't be able to access their money. It would have paralyzed the daily lives of millions of people across the country. Once again, the government had to step in. But this time, the rescue was on a scale never seen before. Tens of billions of pounds of public money were injected directly into RBS to keep it from collapsing. The British state became its majority owner. The goal wasn't just to save a single company. The goal was to prevent a total catastrophic breakdown of the financial system itself. These events weren't just isolated mistakes made by a few bad bankers. They were the culmination of years of growing structural weaknesses. Banks had become too big to fail, dangerously interconnected, and far too reliant on borrowed money or leverage. The complex risk models they used were built on an assumption of stability. Markets assumed liquidity would always be there, and executives assumed the good times of endless growth would never stop. Almost no one had a real plan for what to do when panic set in, because that's the crucial point. Banking systems don't collapse because of spreadsheets and numbers alone. They collapse because of a much more powerful primal human emotion: fear. Once trust disappears, even a financially sound institution can be brought to its knees by a bank run. Fast forward to 2023, and a new test arrived, this time from across the Atlantic. A bank called Silicon Valley Bank collapsed in the United States. Within hours, the shockwaves hit its UK subsidiary, which was the financial backbone for thousands of British tech companies and startups. The threat was instantly recognizable: a suddenness of terrifying loss of confidence, triggering rapid withdrawals and sparking fears of systemic contagion. But this time, the response was different. Regulators acted with incredible speed. Over a single weekend, a deal was brokered. The UK arm of Silicon Valley Bank was sold to HSBC, one of the world's largest banks. All depositors were protected. When markets reopened on Monday morning, there was a collective sigh of relief. Everything was calm. There were no queues. There was no public panic. The contrast with 2007 couldn't have been clearer. Speed, preparation, and decisive action made all the difference. The lessons from the last crisis had, it seemed, been learned. The UK banking system survived 2008, and it navigated the 2023 scare. But survival came at a heavy price. The bailouts massively increased public debt, and the economic recovery took years. More than that, public trust in the financial industry was deeply and perhaps permanently damaged. In response, a wave of new regulations was introduced. Capital requirements, the financial cushion banks must hold, were strengthened. Banks were forced to become safer, at least on paper, yet the fundamental truth of modern finance remains exactly the same. Our economies, our societies, are utterly dependent on confidence. And when financial institutions forget that simple fact, the consequences are never just confined to their balance sheets. They are felt by entire societies, by ordinary people, for years to come. The next crisis will not look like the last one. It will arrive from a different direction, disguised in a new form. But when it comes, it will test the very same foundation that was tested in 2007, and again in 2023. Trust. Because when confidence fails, even the strongest systems can fall. Thanks for watching. If you found this story interesting, consider subscribing for more deep dives into the forces that shape our world. See you next time.